makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. Global bonds march towards their best month since the financial crisis as expectations grow that the Fed is done with policy tightening. German CPI expected to fall after a key region showed prices cooling further in November. We'll bring you the latest figures in just a moment. And Charlie Munger, who helped Warren Buffett transform Berkshire Hathaway into an empire, has died age 99. Now let's have a look at what the markets are telling us this morning. Treasuries seem to be extending a lot of the gains that we saw. There's definitely a clear pivot for the Fed that's being priced in more and more. Now, European equities, U.S. futures seem to be edging a little bit higher. If you look at, the mixed session that we had in Asia, I'm also looking at German bonds. So we're getting some of the CPI inflation data very shortly, but German bonds heading for their longest streaks of gains in more than 4 weeks. Again, as state data is showing that inflation is continuing to slow. Then we look at dollar, always, a dollar dropping for a fifth day. If you look at bonds, overall, they're rallying at the fastest monthly pace since 2008. Again, the story is one of billionaire investor Bill Ackman, the latest one to bet on Fed cuts, and he thinks they could come as soon as the first quarter earlier than the market pricing seems to be suggesting. Now, we're getting the breakdown of German CPI. Bavaria November CPI rising 2.8% year on year. If you look at Saxony, those prices rising 3.9%. Certainly year on year, it's much lower than we had in the last couple of quarters. So let's get the details with Bloomberg's Oliver Crook in Berlin. So, Ollie, good morning. What are the CPI prints actually telling us?
Yeah, so we're just pouring over them now. So we have Bavaria, Saxony, and Hesse that all just came out. So Hesse and Bavaria have made it easy for us. That's down 0.4% month on month. So that is disinflation here in Germany for the two key regions there that together are worth almost 30% of German GDP. North Rhine-Westphalia, which we had earlier today, was down minus 0.3%. So these are substantially lower numbers that we've been seeing. So this is all very sort of encouraging. The headline number that we're expecting in a couple of hours' time is year on year 2.5%. That would be the lowest reading of German inflation since June of 2021. When we look back in the last month in October, what was really driving prices higher? It was still consumption, entertainment, alcohol, and going out. The sort of consumer side of it, energy was sort of moving in the other direction. What does it mean for rates? It depends who you ask. But if you ask the Bundesbank Nagel, he was just saying yesterday that it is way too early to even begin to think about talking about lowering interest rates. They really need to see the read-through all the way.
Yeah, I thought that was really interesting because, so first of all, tomorrow is the big one, right? We have Eurozone inflations, and they're also expected to show only a decline in inflation. But it was interesting to hear Mr. Nagel actually saying that it's not going to be a consistent trend going forward. So I wonder what he sees in the inflation possibly pick up in the next couple of months. How does the budget crisis also impact inflation and the broader economy in Germany?
Yeah. Well, let's deal with that particular point, right? So one of the things, for example, in Germany, you have this budget crisis, and some of the money that was going to go to, that was now subtracted basically from the German government, was stuff that's going to go into energy subsidies, right? So you could see a bounce back in terms of energy prices. That's what Deutsche Bank is expecting in December. But more broadly, in terms of what it means for the economy, Deutsche Bank says that basically since the court ruling, they expect that it changed their whole view on what German growth would be next year. They originally saw growth next year. Now they see contraction, and they say it could shave up to 1 percentage point off of German GDP, perhaps more. And again, they're still working through a lot of it. We just spoke to somebody on the budgetary committee here in Germany, one of the lawmakers, about that. And some of the highlights from the interview there, the question was, will the budget get done by year end? He does not know for sure, but he hopes so. Will there be tax increases to make up for the shortfall? He says no. And critically, will they extend the debt break? Will they suspend it into 2024? He says it's not possible now because of this court ruling. But the main question, and this is what I asked him, will the coalition government survive this crisis? Here's what he had to say.
Yes, if you ask me, yes, you have to compromise, and you have to be honest and say, hey, folks, it's not going as we planned. We have to change plans, and we're willing to compromise. The other thing, like, oh, doesn't work, people don't like us, make new elections, and maybe then they like us. I don't think that is democracy.
And so while things are looking a little bit better on inflation, the budget crisis is really going to hit growth, and there's a lot of question marks still to be seen in terms of this German economy and what the impact of this budget crisis will be.
Ollie, thanks so much. Oliver Crook there with the very latest from Berlin. Now, the narrative of a Fed pause, of course, gaining further traction with dovish comments from Fed officials driving the dollar and Treasury yields lower. Now, the Fed Governor Chris Waller also says we're in a good spot for rates.
I am increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%.
Well, joining us for more on the markets is Sofia Ortega-Costa from Bloomberg's Markets Today team. Sofia, as always, thanks so much for joining us. So much focus once again on cuts. Bill Ackman, I was quite surprised, now expecting a cut even sooner than the markets. And then central banks are still pushing back against that.
So central banks can push all they want, but the market is very much focused on anything that will kind of reinforce this narrative that interest rate cuts are coming. So what was important, and we just played that sound from Governor Christopher Waller, is that he is actually one of the Fed's most hawkish officials. So even if he is comfortable with where interest rates are right now and thinks that will actually bring U.S. inflation down to the 2% target, then it suggests a consensus among Fed policymakers who voted actually unanimously, very different to what we have here in the UK. There was a unanimous vote for a Fed pause. The fact that Bill Ackman is saying that actually the Fed will cut in the first quarter, that sounds a bit too soon, Francine. I mean, if the Fed pauses now, that pause hasn't lasted very long, and although talk around higher for longer, if we do get a cut in the first quarter, that's not very long. So, I mean, it's obviously an outlier bet because the market is pricing in a June cut. Bill Ackman, we know he covered his short Treasury trade a few months ago, so he could just be talking his own book as well.
I mean, I guess the question is, at what point do we see it impact earnings? And when we see impact earnings, if it's quite violent, then what does the Fed do in reaction to that? It's like, how soon could that come?
Yeah, exactly. And we don't know when that lag is, right? Because even though the interest rates have risen quite significantly across the world, that increase has been so fast that we don't know when that will actually feed through to earnings. We've seen that in the credit markets. We've seen some companies warn of a tougher outlook, especially for consumer-facing companies. The luxury market, that's kind of the first domino to fall. So whether we see that first impact, analysts are still forecasting profit growth in the U.S. and even in Europe next year. So there is still a little bit of room for positivity. What tends to happen, Francine, is that those estimates get cut at the beginning of the year. So let's see how fast those cuts will be. But so far, I think Citigroup is predicting as much as 10% growth for the S&P 500 company. So still a positive story there. Let's see if stock prices follow that, though.
Yeah, and what I'm always surprised about is that the market seems to think that actually when inflation is down at critical level, it will continue going down. Whereas, again, when you speak to central bankers, they're worried that it's really tough to get to 2%, but also we could see a bounce back, and that could come at the end of the year.
And whether that 2% target is actually still the target, right? That's one debate also, that BOE Governor Andrew Bailey has alluded to, that the 2% target might not be reached next year. I do think the fact that central bankers are now driving down Treasury yields, bond yields, because it's not just treasuries, right? We're seeing a reaction across the world. That might actually take kind of the impact of higher interest rates and kind of undo some of that hard work against inflation. So there does need to be a balancing act when it comes to talking down the need for interest rate hikes and seeing the impact in the market there, Francine.
Sophia, thank you so much for all of the updates. Sophia Ortega-Costa there from our Markets Live team. Now, coming up, our exclusive interview with Geoffrey Pyatt, the U.S. Assistant Secretary of State for Energy Resources. That's coming up shortly, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, tensions between Washington and Beijing are really putting a spotlight on reshoring, with U.S. manufacturers pivoting away from China to better secure their supply chains. A key focus, of course, is on the arenas of raw materials, including critical minerals and the energy sector. Well, I'm delighted joining me here in the studio for an exclusive conversation is the U.S. Assistant Secretary of State for Energy Resources. He's Geoffrey Pyatt. Thank you so much. You're also former ambassador, so thank you for we have a lot to talk about in this very complex space. First of all, Assistant Secretary, when you look at the U.S., should they actually consider subsidizing some of the domestic critical material projects like processing, but also refining or mining? That would give a competitive advantage.
So two aspects to this. One, it's very clear that we're not going to meet our climate targets unless we can deliver these critical minerals that are so important to the clean tech supply chain at a much greater than market-paced volume. So we need more cobalt, more lithium, more copper, more nickel, more zinc. A lot of that is happening and is going to happen because of the Inflation Reduction Act and the incentives that are provided there, but also our Bipartisan Infrastructure Act in the United States and all of the work that's being done by Department of Energy, by Department of Defense to help both build the energy security aspect of our critical mineral resource, but also, as you say, to develop the volumes that we're going to require. We can't do this alone, which is why I'm here in London today.
But China has massive subsidies, right, for their industries in critical minerals. Is what you just laid out enough to counter some of that? That makes it easier for them to extract it.
So China's dominance of the market is a function in the first instance of their first mover advantage, the fact that they spent a decade acquiring these resources. We're trying to make a better offer based on market principles, driven by the private sector, driven by the high ESGs that are so important to my government, but also to our European partners, our partners in Asia. So it's less about subsidizing than it is about building a structure in which governments and countries are able to say, China's not the only off-taker here. And that's a lot of what we're doing. It's what I've been doing this week in London. Had a terrific conversation yesterday, for instance, with the Nigerian mining minister, who was very, very keen on how do I get more Western companies into my country.
And is that concrete action? I mean, are we going to see a result in the next couple of years? Because there's always a timeline problem.
So you're already seeing some of that action. In the United States, it's being stimulated by the Inflation Reduction Act and the incentives that the Inflation Reduction Act creates for U.S. or FTA partner supplies of these critical minerals. We're negotiating an agreement with the UK right now and with the European Union that would provide those same FTA-level accesses to the U.S. market. But again, this is about building international partnerships. We can't succeed in meeting the climate crisis alone. The United States is 12% of global CO2. We have to bring along the rest of the international community.
I also wanted to ask you about the oil price cap in Russia. Is it working?
It is. It's working. We're trying to do two things at once here. We're trying to reduce the resources that Putin uses to pursue this terrible war against the people of Ukraine. But we're also trying to maintain stability in a global energy market that's been profoundly destabilized by Russia's actions. We're going to continue to work to tighten the noose on Russia's energy revenues. We've done that through our sanctions action against production. We've also done it with sanctions action against ship owners who are found to be circumventing the rules that the price cap coalition set up.
So when you look at the price of oil, it's about $75 a barrel. Is this a good time to actually buy some of that to put in these strategic petroleum reserves?
So the administration is moving ahead on rebuilding its SPR. But again, that's a domestic function, which I'm not involved with. And the key issue here is how do we reduce the revenues that Russia has available to it?
But it's important. Are we going in the right direction? Because there are many questions actually on, what's happened with Russia is that the sanctions have not worked to the full extent that a lot of people thought they would.
So I think it has in two senses. First of all, Russia's revenues are down. You just look at this October compared to last October. But also significantly what the future portends. You've had the withdrawal of major international oil companies from the Russian market. The technology services providers like Baker and SBJ have reduced their exposure. Crucially, the International Energy Agency assesses that by 2030, Russia's oil and gas revenue will be down by 55%, which is an enormous price that Putin is paying for this unnecessary war of aggression that he's unleashed.
When you look at the energy complex for the U.S., I know the strategic petroleum reserves are around 45% lower, I think, under President Biden. What's the optimum? Do you have an optimum amount of how you would replenish them, or is something that you focus on other things?
I mean, I focus on the international aspect of this. I mean, the clear picture is the United States is energy secure.
Yeah.
We have become the world's largest gas exporter, for instance. But we're committed to using that resource in a way that benefits global markets, in a way that's predictable, reliable, and reduces volatility.
Do you worry, for example, about the Panama Canal because of some of the droughts? I mean, we've seen ship stock, and this is a massive deal, actually.
I think it's, the most important aspect of that is what it tells us about the climate crisis and how important it is that we meet our energy transition goals. All of these extreme weather events, whether it's the drought that is reducing the carrying capacity of the Panama Canal, or what you're seeing happening across the global south in terms of extreme weather, the disruption of food supplies. All of this is a reminder. It's the globe screaming at us to say we have to move as fast as we can to drive this energy transition.
Are you confident that something will be achieved at COP28?
So I'm confident that COP will provide an opportunity both to identify the opportunities that this energy transition is providing and to build the broad international coalition. It's very important that COP this year is being held in an oil-producing country because our energy companies, and that's true in the United States as much as it's true in the Gulf, they have to be part of the solution. Yeah. We need these companies to be working with us on decarbonization, on controlling of fugitive emissions, and of driving down the carbon intensity of the energy that they produce, even while we're continuing to invest in the wind, in the solar, geothermal, nuclear, the renewable sources that are going to be the backbone of our future economy.
At the same time, the U.S. is still the largest exporter of LNG. So how do you square the two?
So, again, look at what the Biden administration is doing in terms of trying to reduce the carbon intensity of the energy that we produce. The U.S., like the U.K., we've seen a rapid phase out of coal, which produces immediate climate benefits. Much of that has been replaced by gas over the short term. Domestically, the Biden administration is working to reduce the carbon intensity of that gas that we're producing and supplying to global markets. We also support the measures that are being taken here in the European Union, in Japan, in Korea, to drive the accounting of that carbon intensity. I think you'll see some announcements at COP next week regarding initiatives, the Carbon Management Challenge, as we're calling it, in which we're seeking to enlist the energy companies, the fossil energy companies, to drive down their own carbon footprints.
And if we are going to get this done, you need the U.S. working with China. Were you heartened by the fact that President Biden met with President Xi? Does that make a meaningful difference to these talks?
It certainly does, as does the agreement that was reached between our climate envoy, Secretary of State Kerry, and his Chinese counterpart at Sunnylands. You'll have the U.S. and China working some events together at COP28, specifically in this methane abatement space, for instance. But China, over the long term, is a challenge on these issues of critical minerals, and our fundamental orientation is how do we de-risk our exposure to China on these critical aspects of the energy transition, whether it's solar cells, wind turbines, battery minerals.
Assistant Secretary, thank you so much for joining us today. That is Geoffrey Pyatt, the U.S. Assistant Secretary of State for Energy Resources. Coming up, Spain's Ferrovial is selling down its 25% stake in London's Heathrow Airport, with some going to Saudi Arabia. We'll look at whether the deal will successfully take off. That's next, and this is Bloomberg. Saudi Arabia's public investment fund, PIF, is to buy 10% stake in London Heathrow Airport. Now, part of a shareholder reshuffle, the deal comes from a 25% holding being sold down by the Spanish firm Ferrovial. Now, for more, I'm joined by Benedict Kamel. He's a Bloomberg expert in global aviation. He's in charge of business here at Bloomberg. So, Benny, thank you for joining us. I mean, what does that tell us about Saudi Arabia's, interest in UK assets?
So Heathrow is obviously an important asset in the UK. It's well known around the world. It's one of the biggest airports in Europe. And for Saudi Arabia, this was probably a good opportunity to buy into an asset. There was a willing seller in Ferrovial. They had signaled that they wanted to get out of this. Ferrovial bought the stake or bought the asset in 2006. So we're talking about almost 20 years of ownership. They wanted out. Saudi wanted in. So this was sort of buyer and seller coming together.
And so is it still London's, it's London's biggest airport. Is there anything else for sale? Like, what does it tell us about, things that could come up on the block?
Right now, it doesn't seem like there's anything immediate on sale, but airport assets have always been interesting for buyers from the Middle East. Qatar is the other big owner of Heathrow Airport. Qatar also owns a stake in IAG, the parent of British Airways. So there is interest in these sort of halo assets out there. Qatar also owns a stake in...
Why?
Well, the UK has historically been fairly open to let in foreign owners. Some other countries might be a little bit more wary of letting in Saudi, Qatari assets. And the UK has also always had a slightly more laissez-faire sort of attitude towards this. So it's a 10% stake at this point, so they get a foot in that door. And for Ferrovial, it was probably also the issue that they didn't really see any growth in this asset. So they thought, let's get out at a time that seems like a good moment. And for Saudi Arabia, this might be the beginning of doing more. They've owned football clubs here in the UK, so this is just more of a UK play for them.
Benny, thanks so much. Benedict Kamel there with the very latest on Heathrow. Now, coming up, global bonds soaring at the fastest pace since the 2008 financial crisis. But has the rally got further to go? We discuss that next. This is Bloomberg. Global bonds march towards their best month since the financial crisis as expectations grow that the Fed is done with policy tightening. German CPI expected to fall after a key region showed prices cooling further in November. And Charlie Munger, who helped Warren Buffett transform Berkshire Hathaway into an empire, has died aged 99. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, veteran investor Bill Ackman says he sees the Fed cutting rates as soon as the first quarter of next year. The founder and chief executive of Pershing Square Capital Management spoke to David Rubenstein, who asked him whether the U.S. can actually avoid a recession.
I think it's really hard to predict. I do think the economy is weakening. We're seeing, evidence of that in some of our companies. You're seeing. I have some concerns. There's been a huge subsidy in terms of low interest rates, and most companies fix their rates or their debt at very low rates, and certainly real estate investors did the same. And that works until it doesn't work. And so I think what's going to be interesting is to see what happens when people have to reprice their debt, and I think that can have sort of a cliff-like effect. And you're certainly seeing that in real estate.
Now, the markets are assuming, and the markets are not always right, but the markets are assuming that there's going to be a Fed discount cut sometime next year. And as we talk now, just about the end of November, it's not clear what the Fed will do, but some people say that the Fed, if they were to cut interest rates next year, would help the Democrats and therefore be seen as very political. On the other hand, some people say the Fed can't wait till after the election because the economy might need a stimulus. So you have a view on what the Fed's likely to do?
I think they're going to cut rates, and I think they're going to cut rates sooner than people expect, because what's happening is the real rate of interest, ultimately, which is what impacts the economy, keeps increasing as inflation declines, right? So if the Fed keeps rates in the sort of middle fives, and inflation is trending below 3%, or that's a very high real rate of interest, and I think that is having a sort of retarding effect on the economy. And then, of course, again. Many businesses and certainly many individuals have the benefit of fixed rate debt. And that fixed rate debt, certainly for companies and for commercial real estate, starts to roll off. So I think there's a risk of a hard landing if the Fed doesn't start cutting rates, pretty soon. So, I think the market expects sometime middle of next year. I think it's more likely probably as early as Q1.
By its own admission, the Fed probably missed inflation initially. They said it was transitory, but they played catch up and they've increased rates considerably since that time. Do you think the Fed made a mistake in not handling inflation differently in the beginning? And how do you think they've done since they started increasing interest rates?
They certainly made a mistake. I mean, I think that the Fed generally as an institution would admit that. I think that they caught up effectively, so you give them credit for acknowledging the mistake and being pretty aggressive. And then I think, you want to make sure that they're, Chairman Powell's desire not to have a legacy of causing or contributing to long-term inflation doesn't, cause him to make the opposite mistake, i.e. keep rates too high for too long. And I think the market expectation is, called middle of next year, July, something like this, for the beginnings of easing. I think the economy will likely demand an earlier move. And I don't think of the Fed as or at least this Fed, as a particularly political institution. I think they're really trying to do the right thing.
Well, you can watch that interview with Bill Ackman in full on the David Rubenstein Show, peer-to-peer conversations. The episode debuts right here on Bloomberg TV on December the 6th. That's next Wednesday. Now, global bonds soaring at the fastest pace since the 2008 financial crisis on a dovish shift in Fed expectations. A Bloomberg gauge of global sovereign and corporate debt has returned 4.9% in November so far. That's the biggest monthly gain since December 2008. Now, this comes as the Fed Governor Christopher Waller says the current level of policy looks well positioned to slow the economy and bring down inflation. Well, joining us now from Dubai is our markets and FX guru, actually our guru when it comes to all global bonds, Ven Ram from Bloomberg's Markets Live team. So, Ven, first of all, I really want to hear your thoughts on Treasury. Are we going to see this Treasury rally more in the coming days?
Morning, Francine. Thank you for the kind words. You're too kind. Well, I do think that there is a short-term basis for a short-term tactical rally from what Waller said, because not only was he dovish, but he expressly said that during the question and answer session, which I think many in the media have missed, is the fact that he's talking about rate cuts. If we see successive rounds of disinflation, we've already seen a fairly entrenched disinflationary process, and if it continues, he's basically saying that there will be rate cuts. And if that is going to be the guiding factor for the markets, as it is now, I think that rates have plenty of room to rally, particularly the long end, because real rates are high.
So do you think the market is just pricing, that the pricing for a Fed rate cut is right, or is it just wrong?
No, I think the markets are kind of pricing a first rate cut in May, and I think that that's pretty much in the ballpark. I think a lot of it will depend on the further disinflationary process. We are expecting core inflation to come in at below 3.7%. 3.7% is the level that the Fed indicated we will get to by the end of this year. So if we get 3.5% this week, that will tell the Fed that, look, the disinflationary momentum continues. But of course, 3.5% is not 2%, and there is plenty that will drive the narrative between 3.5% and 2%. And we just need to wait for the data points and the economy to see how the economy fares between now and spring of 2024.
So, Ven, what are you expecting? Again, it's not linear. A lot of central banks are really pushing back against this idea of interest rate cuts. But I don't know how difficult is it at this point in time to know what inflation does and therefore what the reaction function will be?
I think the reaction function will be a lot different for the major central banks at the very least. We have got the Bank of England pretty frantically pushing back on the notion of the markets that, look, a rate cut is round the corner. I think the markets are pricing a rate cut from the BOE in August, and the BOE has been pretty much all of this week been drumming home the message that, look, a rate cut is not on the cards because services inflation and core inflation are simply too high. It's not the same narrative in the US. In the Eurozone, it's a bit more nuanced, where I think that the ECB has a bit more room to be loosening policy later on next year. So the reaction functions are going to be pretty starkly different, Francine.
Thank you so much, as always, for all of your insight, Ven Ram, from our M Live team in Dubai. And you can also follow everything, of course, on the Bloomberg terminal. Now, Bloomberg's Joe Easton is here with a check on your stocks on the move. Hi, Joe.
Morning, Fran. So there's more disappointment for Philips today, which is slumping over in Amsterdam after the US FDA warned last night that some users of the DreamStation 2 sleep apnea device have been warning that it is overheating at times. Now, this product was actually issued as part of a recall of the original DreamStation 1, which was emitting a foam which was said to be hazardous, and Philips has already set aside around €1 billion in order to fix that problem. That stock now headed for its worst day in around a year and is down more than 40% since the company announced the issues in that product in 2022. Meanwhile, we're also over in Spain looking at Ferrovial as the Saudi wealth fund buys a stake in London's Heathrow Airport, the UK's busiest airport. Now, this is priced at around £2.4 billion. Some of the stake is also going to private equity, but the sale to the Saudis is potentially controversial. But it is a good price for Ferrovial, which has had a stake in Heathrow Airport since 2006. It is around 70% higher than analysts at Morgan Stanley were expecting them to sell that for. And as such, we're seeing Ferrovial jumping around 2.5%, one of the best performers in Madrid today. Finally, a stock that's not doing very well at all is Halfords. This one dropping as much as 23% today. The UK retailer of bikes and also car products warning that people in Britain are cutting back on big-ticket items, so big slowdown in sales following the surge that we saw during the pandemic, people cutting back due to the cost of living crisis. The car maintenance business does remain pretty strong, given that's pretty recession-proof. People still need to maintain their cars during a recession, but it is the big-ticket bike items hitting that stock. Liberum cutting it to sell, and that's the biggest decliner we've got in the UK today.
Thank you so much. Our Joe Easton there with the stocks on the move. Now, also making news, Amazon rolling out a workplace chatbot called Amazon Q. This could be good. Now, it's designed to help corporate customers search for information, write code, and review business metrics. Amazon Web Services, the company's cloud computing division, is adding generative AI into more products to reclaim ground in a field led by its main rivals. Microsoft and Google have announced similar moves. I was hoping for something to do with expenses, the fact that they would file them for you. Bloomberg understands that Miriam Adelson, the widow of casino magnate Sheldon Adelson, is buying a majority stake in the Dallas Mavericks NBA franchise. Now, in a regulatory filing, the Adelson family said it already has a binding purchase agreement. The Mavericks franchise is currently owned by Mark Cuban. Now, the Adelsons are selling $2 billion in stock in Las Vegas Sands to fund the acquisition. And Morgan Stanley is fighting to overturn a French court ruling after it was ordered to pay 1.4 million euros to bonuses to a former banker who quit. While former employee Bernard Moureau's lawyer argued his client bonus should be paid with the bank, arguing they were only payable if he'd stayed on. Now, the case could affect attempts by investment banks trying to prevent their best performers leaving their jobs. Coming up, ahead of the COP28, we take a look at the ESG Market Navigator survey results from Bloomberg Intelligence. Through the lens of ESG, we'll talk climate finance, geopolitical risks, and more. That's next, and this is Bloomberg.
Number one, this is what's called a stock take year. Governments around the world will show up and show the progress they've made in terms of getting closer to net zero by 2050. Number two, climate finance. How can we get more money from the richer part of the world to invest in green technology? Number three, so this year's COP is in Dubai. There's a lot of controversy around the fact that it's run by an oil and gas superpower, but they are also very conscious of that, and they're making a big push to get oil and gas companies to commit more to cutting their methane emissions. That would be a big deal. And the fourth point we're looking for is going to be getting countries to commit to tripling their investments in renewables by 2030. So those are the four main points that we're going to be looking at COP this year.
That is, of course, John Fryer, Senior Executive Editor for Energy, Climate and Equality, with a look at what to watch as COP28 begins tomorrow. Now, ahead of this year's COP, Bloomberg Intelligence has also reached out to over 200 C-suite executives and investors to take really the pulse of ESG market sentiment. Now, we're now joined, I'm delighted to say, by the report's author, Adeline Diab, who's also Chief ESG Strategist at Bloomberg Intelligence. So, Adeline, congratulations to you and your team to actually really putting this amazing survey together. The question is ESG dead or not? How did people answer?
So ESG is definitely not dead. With the recent backlash dominating the news, we wanted to cut through the noise and really ask markets their perception and priorities about ESG. So this is why we conducted this global survey, Bloomberg Intelligence ESG Market Navigator. And this reveals that basically ESG has become a backbone to both financial markets and corporate strategy. 85% of investors see ESG leading to better returns, more resilient portfolios, and enhanced fundamental analysis. 84% of corporates see ESG helping to articulate stronger corporate strategy and actually take into account in their M&A plans.
Is there a concern, though, I guess, in this geopolitical context where it's extremely fluid, it's extremely concerning, there's two wars that actually it's taking a back step compared to some of geopolitical issues?
So, yeah, geopolitical and macro risks have been two risks ranked by investors and corporates as reasons that may deter them from their ESG plans. However, the long-term agenda remains intact. 85% of both investors and corporates plan to boost their ESG investments and assets under management, their capex and spending. We expect 3 times more investors to increase their ESG research budget by 20%. Both groups really are pursuing ESG in a bid to improve profit, brand value and competitiveness.
So, Adeline, at the same time, is it now just much more acceptable to invest in fossil fuel?
So that's a good question. And 60% actually of investors recognize that it has become more acceptable to invest in fossil fuels due to the energy risks, security risks that have emerged over the past 18 months. But the survey also reveals that energy transition is top of mind. 70% of executives really see energy transition as a competitive advantage that also gives them access to cheaper financing, access to capital that is key, and all the scrutiny that is associated to that is worth the commitment. And actually, 81% of executives fear losing market value and activism if they fail on articulating a strong energy transition plan.
That's really interesting. What are you expecting from COP? So you'll be traveling to COP. I mean, there's expectations are not actually very high, but there's also a lot of stuff that needs to be done to lay the groundwork for them for the future.
Yeah, I guess what to watch for really. So I would say climate has went from a fringe concern to becoming mainstream to becoming mandatory over the past decade. But now it's really about accountability, and that's what I would watch for this year. And I would make 2 points. One is energy transition plans, which you just touched on. According to our survey, only 57% of executives believe that they will reach their net zero targets, and 67% believe their peers will not reach their net zero targets. So it's very important for corporates to focus on articulating those transition plans. But the second point is that to deliver this accountability, the investor-corporate dialogue will be key. Yeah. And according to our survey, 60% of investors are asking questions and holding companies to account. And 40% of executives admit facing ESG and climate questions on half of their investor calls. So this is strong reasons to be optimistic.
Adeline, thank you so much for everything and a wonderful survey. And we'll catch you, of course, in COP to see what the latest survey will tell us. Now, Adeline Diab from Bloomberg Intelligence. Now, also stay with us. So we'll bring you all of our top lines from this year's United Nations Climate Change Conference in Dubai. COP28 begins on Thursday night. Finance Day is actually on Friday. We'll preview discussions on net zero progress, climate finance, and much more. Coming up, remembering Charles Munger, Warren Buffett's longtime right-hand man, who's died at the age of 99. Berkshire Hathaway has announced the death of longtime vice chairman Charlie Munger. He was 99 years old. Now, Warren Buffett honored his right-hand man, saying his inspiration, wisdom, and participation helped shape Berkshire Hathaway. Now, here's a look back on his life and legacy.
Charles Munger served as alter ego, sidekick, and foil to Warren Buffett for almost 60 years as they transformed Berkshire Hathaway from a failing textile maker into an empire. A lawyer by training, Munger helped Buffett craft a philosophy of investing in companies for the long term. In 1962, the two men began investing in Berkshire Hathaway, a Massachusetts company that made men's suit linings. Even after the mills closed, Berkshire stuck around as the corporate vehicle for a growing conglomerate of companies. Focusing on businesses with strong brands and pricing power, Munger nudged Buffett into acquiring California confectioner See's Candies in 1972. The success of that deal inspired Berkshire's $1 billion investment in Coca-Cola stock 15 years later. At the company's annual meetings in Omaha, Nebraska, where he and Buffett had both grown up, Munger was known for his roles as straight man and scold of corporate excesses. The acerbic Munger so often curbed Buffett's enthusiasm that Buffett jokingly referred to him as the abominable no man. Still, for many years, Munger was more bullish than Buffett when it came to investing in China. His purchases of stock in Chinese automaker BYD resulted in Berkshire becoming that company's largest shareholder. And even as his partner became a worldwide celebrity, known far and wide as the Oracle of Omaha, Munger believed Berkshire's success would outlast Buffett's star power.
In my opinion, Berkshire will flourish after Warren's gone. I don't think anybody is essential given the momentum we now have in place.
He didn't overstate his own importance either, sharing his vice chairman title at Berkshire in 2018 with two next-generation senior executives, Greg Abel and Ajit Jain, and affirming the company's commitment to a succession plan.
Well, joining us now for more on Munger's life and legacy, Bloomberg's Charlie Wells. So, Charlie, thank you for joining us. I mean, he was an extraordinary man, actually, because of what he's achieved. But for people that are a little bit unfamiliar with him, what was so special about Charlie Munger that really made him Warren Buffett's right-hand man?
Yeah, well, they had a partnership that really went back so many years. They met sort of by chance in 1959 in Omaha, Nebraska. And that was actually the hometown of both of these men. Munger was born in 1924. He actually worked Saturdays at the grocery store that belonged to Warren Buffett's grandfather. And from the moment they met, they really hit it off. They had phone conversations almost daily for hours where they talked about investment strategies. And I think what's really striking is that, we hear so much about Warren Buffett. We know that he does like attention, and we know that Charlie Munger sort of pulled him back. He had a very different perspective, but also educated him in a lot of the ways of investing and kind of shaped his strategy.
Yeah, but he has a lot of groupies, or there's still a lot of quotes from him, like all over the internet, on Instagram. So what were his principles that he invested on?
Well, he was known for quoting the likes of Confucius, of Mark Twain, but even some of his very own quotes, really almost rank up there. So he said one thing to Warren Buffett early on in their career, and it was, stop looking for fair companies at wonderful prices. Look at wonderful companies with fair prices. And that kind of changed Buffett's trajectory going forward. So he had invested in companies that he himself called cigar butts, which were effectively companies sort of on their last puff. And basically the turn here was to look at firms that had pricing power, that had, name recognition. Started, really in earnest in 1972 with See's Candies, a chocolate company from California. But they took a lot of those learnings to firms like Coca-Cola and Apple, which really are just, some of the best investments that they made.
It's just amazing. Thank you so much, Charlie Wells, there with, of course, all of the latest remembering the man that was Charlie Munger. Up next, we have Bloomberg Brief, Danny Berger in London, Manus Cranny in New York. We'll have a full roundup of all of our top news stories. We also look at the markets with that Bill Ackman interview that David Rubenstein did on him expecting Fed cuts even earlier than the markets. This is Bloomberg.